Let's talk now about global diversification. It's been brought to the fore recently with the very differing performances of places like China and the United States and Europe. And when we come back to South Africa, it's a divergence that is quite startling. So we have to diversify our portfolios. What about a global diversification? In the studio in Johannesburg is Giles Mokoka from SEI Investments. Giles, I mean, diversification is all very well, but it seems to me it's coming to the fore even more at the moment, with central banks doing one thing here and one thing there, and stock market performances all over the place.
Yes, Lindsay, indeed. Good evening. Lindsay, I think the issue is, the world is a very scary place now. If you look at what's happening in the Middle East with ISIS, you look at what's happening in Russia with this separatist movement. The same themes that dominated global markets last year have continued to do so this year. I think if you look at also Europe in particular and Greece making headlines, I think it's the same themes, it's just that they've been increased a notch or two. As a result, I think we as advisors and investors need to mitigate against the risks that we face, the increasing levels of risk. And diversification is one of those tools that we can use for risk mitigation. A lot has been written about global diversification and the benefits thereof. And it has to do, as you've mentioned, Lindsay, with the fact that policies, monetary and fiscal policies affect markets differently. That is why also, if you remember, what's often said is don't keep your eggs in one basket, or don't be stuck in your own backyard. It's very important
yes,
to
indeed.
have...
In fact, Wayne McCurry was saying exactly the same thing to me a couple of weeks ago on this very show.
So it's very important, yes, to have all those...
Goodness me, I mean, how many times have we heard that? I mean, Wayne, do you concur with Giles on this point?
I mean, Giles, diversification is a couple of things about it. First of all, it's been described as the only free lunch.
Only free lunch, that's
right. The only free lunch in investments. However, you can diversify yourself out of existence and just buy an index, because an index is, let's say, the most diversified type of exposure you can get. Do you feel that investors obviously want diversification, but to what extent do you feel investors, investment managers should express a view in their portfolios without diversifying themselves into oblivion?
Yes, Wayne, I agree with you. Ice cream is good, but not too much of it. So you can actually diversify yourself too much and therefore not get those benefits of diversification. I think as a South African investor, you have to be aware that the world is a changing place. There are 30 developed equity markets around the world. 64% of all investable market capitalization sits outside the US. So it doesn't matter whether you're sitting in the US, a portfolio manager sitting in South Africa. As the world changes, you have to really make sure that your clients' portfolios are in tune with what is happening in the world in terms of market cap, in terms of the different areas which offer an opportunity for a higher return. It's all about risk-return metrics. As you said, diversification is a free lunch, which means for the same amount of risk, a globally diversified portfolio has tended to give a higher return compared to a local portfolio. So whereas you're right, you can diversify, over-diversify, it's important to be able to take that into consideration, that you are getting a free lunch.
Giles, I think what the message is here, although we could go on for a long time about this, but I think the word is over-diversify and get killed, or if you don't diversify, you'll die. Thanks so much for your time this evening. That's Giles Mokoka from SEI Investments.